Ever hear investors talking about bonds and thought, is that like James Bond but for money? Not exactly. Bonds are actually one of the oldest, most reliable ways people and big institutions move money around, and for a lot of investors, they're a solid way to earn steady returns without the roller coaster ride of the stock market. Let's break it down, step by step, without the boring textbook talk. What a bond really is. Think of a bond as an IOU on steroids. It's basically a loan, but instead of you borrowing from a bank, you're the one lending money, and your borrower is usually a company or government. Here's the trade. You give them your money now. They agree to pay you interest at a set rate for a set amount of time. When that time's up, the maturity date, you get all your original money, your principal, back. Companies and governments issue bonds all the time to build things, fix things, or just cover big expenses. They're not doing it out of kindness. They're doing it because bonds are often cheaper than other ways of borrowing. Why people buy bonds? Some investors use bonds to protect their money while still making a little extra income. Unlike stocks, which can go up, down, or sideways with no warning, bonds are generally seen as more predictable. They can be a nice counterbalance in a portfolio so you're not all in on stock market drama. Example, the City Stadium bond. Let's say the city of Fairview wants to build a baseball stadium. Price tag? Big. So they sell bonds to raise the money. Each bond costs $1,000. They'll pay you back in 10 years. To make it worth your while, they promise 2% interest every year. So, you buy a bond for $1,000. Every year for 10 years, Fairview sends you $20, that's your interest. After the 10 years are up, they give you your $1,000 back. They get their stadium, you get steady cash plus your money back. Simple, right? Why bonds feel more stable? Bonds usually give you regular income, interest payments, called the coupon. Return of your original investment when the bond matures. Compare that to stocks, where your income depends on dividends that might be cut, or selling your shares at the right time, way less predictable. But bonds aren't risk-free. Here are the main risks. Default risk, the issuer, the borrower, might not pay you back. If they go broke, your money's gone or heavily reduced. Safer issuers, like big governments, usually pay lower interest. Riskier issuers, like smaller companies, often offer higher interest, but there's a reason for that. Interest rate risk, if new bonds hit the market with better interest rates than yours, your old bond is suddenly less attractive. If you try to sell it before maturity, you might have to drop the price to compete. Credit ratings, your bond's report card. Agencies like Moody's or S&P give bonds a rating, kind of like a credit score for the issuer. Higher ratings mean lower default risk, but also lower returns. Lower ratings mean more risk, more potential reward. Pro tip, these ratings aren't perfect. Always do your own research instead of relying only on the letter grade. Why investors mix bonds with stocks? Bonds and stocks don't always move the same way. When stocks are down, bonds sometimes hold steady or even go up. That's why many investors blend both. Bonds help protect your portfolio and smooth out the ride. The bottom line. Bonds can be a solid choice if you want steady, predictable payments. Lower risk than stocks, in most cases. A way to diversify your portfolio. But they're not a magic bullet. You need to understand the risks, the terms, and the issuer before you invest. Like all money moves, education first, investment second. If you like this video, give me feedback and like, share, subscribe channel.